you're not too big to fail, but you're big enough to take down the system if you do. And you know the old expression, the time to buy is when there's blood in the street.
University of Penn Law and NYU Law. He was a lawyer on Wall Street, an investment banker. He successfully negotiated the LTCM deal on behalf of a lot of very upset investors, and he did that very well. He's the author of 6 books, most notably Currency Wars and The New Case for Gold, amongst others. Jim, thank you for joining us, and welcome.
Thank you, Sean. It's great to be with you. A lot of people ask me why I have 2 law degrees. I tell them once is not enough. So you just the fun keeps coming.
Oh boy, yeah, excellent, excellent. I tried to be a lawyer, then I took one course and thought, I don't think I could read that much, but good for you for doing that. Excellent. Jim, the reason why we have you on, besides just the absolute treasure chest of knowledge that you have, is that you wrote a really excellent article on the banking crisis and how we're not out of this mess yet. It seems that there are a lot of politicians like, oh, it's all over, everything's fine, nothing to see here, almost Chemical Ali mode. If you wouldn't mind, could you take us back to earlier in the year and just explain and reiterate what happened first?
Right. I'll be glad to do that, Sean. And just, I kind of cut to the chase. The banking crisis is not over. The crises don't happen all at once in one day. They emerge, regulators deal with them, the other new investors come in, they go, oh, it's all good, we got this under control. And then there's 2 or 3 months of a quiet period, and then they just pop back up again. It's because they were never fixed in the first place. A lot of people think this all started with Silicon Valley Bank, and that was March 10th, 2023, when the FDIC declared them, well, basically took over, put them into receivership. But that's not quite the right starting date. The day before March 9th, there was another failure. It was Silvergate Bank, not Silicon Valley, but Silvergate. Silvergate failed, basically closed its doors and went bankrupt. And they were an FDIC insured bank. They were a member of the Federal Reserve System. So they weren't some kind of weird, semi-bank or shadow bank or whatever you want to call it. They were a real bank. But they had one foot in the mainstream banking world at the Fed, but they had another foot in the crypto world. And they were actually a portal between crypto and dollars. And you could buy and sell crypto and get dollars. They would credit your account and all that. But when I saw the crypto collapse coming, or not coming, it happened. November 2021, Bitcoin was $69,000. By November 2022, it was down to around $13,000, give or take. So that was a 90+% collapse. And I saw that. I said, well, there's no way this is confined to Bitcoin. And I was right. A lot of crypto exchanges failed. But the question I kept asking myself, is there a danger, and there is a danger, that there'll be contagion from the crypto world to the banking world? That was the question I had. Because crypto, it could all go to zero, knock yourself out. But if it goes into the banking world, we got much bigger problems. And it did. And Silvergate was that portal. Okay. Next day, Silicon Valley Bank fails. And the FDIC did a very interesting thing. They did their job. And by that, I mean, they issued a press release. The press release came out at 6 p.m. on Friday, March 10th, 2023. And it said, we are insuring all deposits up to $250,000. That's what we do. But if your deposit is more than that, you're uninsured. We're going to give you what they call a receivership certificate. Hang on to it. We'll get back to you in terms of what it's worth. You can't cash it in. We don't know what it's worth. We will then proceed to sell the assets of the bank, pay off creditors. And if, as and when there's anything left over, we'll distribute that to you on a pro rata basis. But, just hang on. We'll get back to you in terms of what this is worth. Well, it turns out that, of course, this was all known. Just had to look at the data. Silicon Valley Bank only had 3% insured deposits. 97% of the deposits were uninsured, and the amount was approximately $140 billion. And they weren't all like, $2 million A-round startups. You had Roku, Cisco, and other names, big Silicon Valley names that had multi-billion-dollar deposits. And for that matter, one of the crypto exchanges had a $3 billion deposit at Silicon Valley Bank. So it wasn't clear that they weren't going to fail. I mean, this was contagion and recontagion, if you want to think of it that way. So what happened over the weekend between March 10th and March 12th? All the crybaby billionaires, Bill Ackman, all these guys, they all go running to the White House saying, "You don't understand what you're doing here. We got 200 startups in Silicon Valley. They all got like 3, 5 million. They got payrolls, they got employees, they got rent, they got technology development. You're going to destroy the tech sector if you don't bail this out." And so then on 6 o'clock Sunday, just 48 hours after the first announcement. By the way, I should add that going back to the Friday announcement, that actually came out of the Brisbane G20 meeting in 2014. In 2014, Brisbane G20, we were still in the aftermath of the 2008-2009 financial crisis. There was an uproar. Citizens were, pardon my language, they were just pissed off. The taxpayers bailed out the banking system and all the billionaires kept their jobs. So Jamie Dimon, he's still collecting bonuses, Goldman Sachs, all of them. None of them failed. They would have failed, but for the fact that they were all bailed out. But the everyday Americans are like, unemployment's 9%. I lost my job. I lost my 401ks down 50%, et cetera. So there was a political reaction to that. So in Brisbane 2014, they came up with not the bailout theory, but the bail-in theory. And bail-in means that if a bank fails, the investors, the stockholders, the bondholders, the depositors, they have to basically pay off the creditors. They have to pay off the depositors. And only when there's nothing left would the government maybe chip in. So what and they put the world on notice. The insured amount in Europe is 100,000 euros. US is $250,000. But the whole world was on notice. That's all we cover. Over that, you're on your own. Well, what the FDIC did on Friday was actually consistent with what they all said they were going to do in 2014. It was a bail-in. And if you had $1 billion deposit, you're going to contribute to the rescue. Within 48 hours, they did a 180-degree turn. They completely blew away the $250,000 insurance limit. They said, we're guaranteeing all the deposits, multi-billion-dollar deposits. By the way, a dirty little secret about what happened at the White House. I said that, the Silicon Valley billionaires were all crying about all these little startups and all this stuff. The truth is, a lot of what Silicon Valley Bank was financing was green technology. They were a climate bank. And of course, that's all you have to say to the White House. Hey, this is green. And oh, yeah. Now, what were they doing? I don't know, battery technology, better windmills. None of that stuff works, by the way. But no. they were in the White House sweet spot by saying green, and they were. That was actually what they were financing. Everyone thinks, oh, somebody's working on an app. They weren't apps. They were like battery power. So they get bailed out. At the same time, on Sunday night, now we're talking March 12th, they closed another bank, which was Signature Bank. Something about S, Silvergate, Silicon, Signature, all the S's were going down. Now, Signature Bank was another interesting case, which was Barney Frank was on the board of Signature. And if that name rings a bell, just think of Dodd-Frank. Dodd-Frank, 2010, 1,000-page legislation. I know I met Barney. I know Chris Dodd very well. That was supposed to solve all the problems of the 2008, 2009 financial crisis, et cetera. Here, the author of the bailout legislation is on the board of the bank, and his bank gets shut down. Well, what's up with that? Well, they had they bought government bonds, and when interest rates went up from 10-year note, treasury note yield to maturity went from 1 3/4 to 4. All those bonds lost 80% of the value. That's what happens on long duration bonds. Bond math is simple: rates up, price down, vice versa. Well, the rates were up, the price was down, so they were underwater and insolvent, and they got shut down. So Barney Frank's out whining the next day. He's like, "Hey, yeah." But that's true of every bank in the country. There's not a bank out there that didn't load up on treasury bonds at 1 3/4. They're all underwater. They're all insolvent. And by the way, the Fed announced a facility. They always have these 4 initials. I forget what this one was, like BA or whatever. But basically what they said was, if you're a member bank and you have treasury securities that are where the mark-to-market value is below par, so you paid 10 million, but they're only worth 8 million. And that was the case across the board. So they get trillion dollars or more of bonds that were in that category. You can deliver them to us, and we will lend you for 1 year the face value. So you're putting up 80 cents of collateral, but you're getting a 100-cent loan. I said, I got a 15-year-old car. Will you lend me what I paid for it? Because it's a lot more than it's worth now. But that's what they did. So now my head's spinning. I'm like, well, I get all this stuff, but I'm like, oh, so you just guaranteed every deposit in the banking system without limit, and you just guaranteed every treasury bond at par value without limit.
Yeah.
What's left? Like, what else do you have in your bag of tricks? Because you don't have it. There's nothing else you can do. Go back to 2008, they guaranteed every money market fund in the country. So, but here's Barney Frank whining, hey, yeah, my bank was in trouble, but so was every bank in the country. Why did you whack me and give all these guys a pass? Well, the answer is Signature Bank was another crypto bank. It had a portal called Signet. And Signet was a portal to the crypto world. And that's why they whacked it. Notice they whacked two crypto banks. So now it's Monday morning, where are we now? The 13th. Everyone's asking Janet Yellen, it's like, wait a second, what just happened? You guaranteed every deposit in the banking system. And she's like, well, no, not really. It's only if you're systemically important. And you're like, okay, could you please define systemically important so we can tell? Because we're getting our money out of all the banks that are not. And the truth is, you can't, because the system is so densely interconnected. And this is why they say financial contagion. I mean, it's a metaphor, but actually the mathematics of a viral spread. We just went through a pandemic, but this has been true, for as long as it's been studied. The mathematics of viral contagion are identical to the mathematics of financial contagion. The equations are the same, the way it spreads. And of course, Janet Yellen can't define systemically important. Number one, they try, but they can't. Number two, I don't care how small you are. If you're a small bank and there's a run, the guy across the street, he's getting his money out of that bank. And again, it's like COVID. It's like it just keeps going until the system collapses, which means by definition, just by the dynamics, there's no such thing as a bank that's not systemically important because they're all connected. Even the little banks are borrowing from the big banks, et cetera. So Janet Yellen hemmed and hawed and didn't have a good answer. She never does. She's not that bright. And so there we are. So the Fed has guaranteed every bond at par value, even if you're worth 20% less. And the FDIC has guaranteed every deposit, and Janet Yellen can't give you a good definition of what's covered and what isn't. Okay. Now a week goes by. What's on tap for the next weekend? Again, Friday night press release, shotgun wedding, Credit Suisse and UBS. Now you're talking to big guys. These are two of the biggest, oldest banks in the world. I think Credit Suisse have been around since the 1870s, maybe, and I'm not sure about UBS, but they were the two biggest banks in Switzerland. So Credit Suisse fails, and they get taken over by UBS. Okay. And now everyone's like, oh, what's next? Who's next? And there's a list. I'll go through it in a minute. What factors come into play? How can I think about whether a bank is likely to fail or not, regardless of whether they're getting bailed out? And there are two metrics that are really good. One is look at the ratio of uninsured deposits to total deposits. If that number is more than 30%, you're a sitting duck. And in Silicon Valley's case, it was 97%. They were 97% uninsured. So a little local bank that's got, I'll say 30% uninsured and 70% insured, they're very unlikely to have a bank run. Most of those customers are like, hey, I'm covered. I'm good. I got 100,000 in the bank. All good. But when you're up north of 30, certainly north of 50, 70, 80, 90, you're an accident waiting to happen. Yeah. The other metric is total assets. So there really are too big to fail banks. Doesn't mean they can't fail, but it means they're 100% guaranteed to get bailed out. And that list is well known. So who's too big to fail? Like, you can put your money in, they can screw up really badly, and you're not going to get hurt as a depositor. Right. JP Morgan Chase, Wells Fargo, Goldman, the usual suspects, Goldman Sachs, US Bancorp, Capital One, TD, State Street, Citi, B of A, Morgan Stanley, PNC Financial, Bank of New York Mellon, Truist Financial, and BMO Harris. They're the giants. Okay.
Right.
I'm not saying they can't fail. I'm saying that there'll be a safety net put under them, and no one's going to lose anything except maybe stockholders, but not bondholders, not depositors. But there's another category where you're bigger than the local savings bank, but you're not too big to fail. You're not on the list of giants. And these are banks with between approximately 100 billion and 400 billion of assets. When you get up closer to a trillion of assets, you're in the big leagues. But 100 billion to 400 billion of assets, you're not too big to fail, but you're big enough to take down the system if you do. And these are the ones that are vulnerable, and these are the ones where depositors and stockholders in particular, really need to drill down. I'm not saying get all your money out tomorrow, but the banks that fit that category that I just described: Citizens Bank, Manufacturers and Traders, Comerica, Webster, East West Bank, First Citizens Bank, City National Bank, not Citibank, but City National, First Horizon, Western Alliance, Valley National, Synovus, Frost Bank, Pinnacle Bank, Cadence Bank, BOK Financial, and South State Bank. That's the list of banks that are big enough to cause a systemic crisis, but not literally too big to fail.
That's not a small list.
No,
that's a lot.
I lost count, but that's like 8, 10, that's like 15,
Yeah.
16. But they're
Oh my
all,
goodness.
these are, and we, in our newsletters, we occasionally put out recommendation, not all at once, but buy put options on this bank because we think they're shaky. And remember, the stock can go way down, and the bank can still get bailed out. In other words, even if the bank gets bailed out and depositors don't lose money, it doesn't mean your stock can't go from 50 to 10. And
Right.
that's no reason to buy a put option. But the number one bank on that list, going back to now I would say April, was First Republic, and everybody knew they were in trouble. And they got like a $30 billion, I think approximately, kind of a bailout. It was, the usual, again, Goldman Sachs, Morgan Stanley, Citi, a number of other banks on that A list that I described earlier pitched in like 5 billion each, and they got $30 billion. But that was not capital. That was a loan. So they had liquidity. So you solved the liquidity problem, but you didn't really solve the solvency problem, which is a different issue. But everyone knew that was temporary because they had to pay it back, and how were they going to do it? And all they were really doing, they were propping up the bank long enough so the FDIC could find a buyer.
It was JP, wasn't it?
Yeah, sorry, JP Morgan, you're right. When JP Morgan won it, they got a sweet deal because they wanted the asset management business. They didn't care about the depositors. They got
No,
enough
totally.
They wanted the asset management business, which is off balance sheet and recurring. Stock market will give you a 20 multiple on that. And they had to take some loans that might suffer losses, but the FDIC guaranteed the loans. So the downside was protected by the FDIC. The upside is all in Jamie Dimon's, purse. And there you go.
And he got Bear Stearns for a song back in '08 as well.
Oh yeah,
He
yeah.
did, he's a very good bargain shopper, that Jamie Dimon guy.
Yeah. Bear Stearns, that stock went from like 130, and the bailout number was 2.
Too.
And then there was a lot of crying. And they said, could you give us 8 or something? So he's finally said yes. So they got $8, give or take. I was like, oh, good. The crisis is over. We got through Silicon Valley Bank. The tech startups still have their working capital. First Republic got picked up by JP Morgan. Everyone else on the list seems to be doing fine. Market calmed down. The banking crisis is over. That's the Wall Street Goldilocks soft landing story. All right, let me explain why the banking crisis is not over. And for this, we're going to use a little financial history, which is underrated, but in my view, extremely valuable. Maybe just because I've been around long enough. I'm kind of a magnet for trouble when it comes to this. My first banking crisis was the Herstatt Bank in Germany in 1974. So
Hey.
you got to be, you have to have been around a while to remember that one. That was a foreign exchange. That was a bank where, in those days, if you were in Germany and the U.S. and you were doing foreign exchange trading, and you sold, it was Deutschmarks because it was before the euro. If you sold Deutschmarks for dollars, you would, or bought them rather, they would deliver the Deutschmarks to you in German time, and then you would pay the dollars in New York time. Well, they failed in between. They got all the Deutschmarks, but they never paid the dollars because they failed in the middle of the day, and that started a crisis. But anyway, it's a long list since then. But let me point to 2 in particular, and then I'll come back to 2023.
Mhm.
So the first one I had some at a front row seat, 1997, 1998, the Asia-Russia LTCM financial crisis. Now, what people don't realize, people remember, September 1998, LTCM's go under, about to go under $1.3 trillion in derivatives. That's back when a trillion was real money. But it wasn't, the Fed had no interest in bailing out a hedge fund. I was there, I was their lawyer. We didn't expect a bailout. We're like, why would the Fed bail out us? I mean, it was mostly our money, by the way, so that's why we weren't lynched. But why would the Fed do that? Well, the answer was it wasn't about us. It was about the 19 banks that were going to fail if we failed, because they're dealers. So if they sell us, $1.3 trillion of derivatives, which they did, they buy them from the other side. Okay.
Yep.
And they're relying on the fact that they have a two-sided position and they make a spread. That's what they do. Well, if one side of the trade goes away, all of a sudden they're net short, they're naked on the other side, and they got to go out and sell stocks like it was $15 billion worth of stocks to cover the fact that they were long that much on their side of the swap. Well, I can tell you what $15 billion of fire sales stocks will do to the stock market. They would have closed the New York Stock Exchange and a lot else beside. So technically, they were bailing us out. We got $4 billion in cash, put the fire out, brought it in for, foamed the runways, brought it in for a soft landing. But they were really bailing out Wall Street. And we lost the money. Wall Street put in the $4 billion, but then Wall Street owned it. And they got all their money back a year later, but they put out the fire. But here's my point. That didn't start in September 1998. That started in June 1997 in Thailand, when Thailand had a run on the bank. Dollars were leaving the country. They had pegged the Thai baht to the dollar, and people panicked. They said, because money had been going in for resorts and casinos and who knows what else. And everybody wanted their money back, taking the dollars out. The Central Bank of Thailand could not maintain the peg. They imposed capital controls, said no more dollars, and we're going to devalue the baht, which meant for a U.S. investor, all your money was worth a lot less. That then spread to Malaysia, Indonesia, Singapore, pretty quickly spread through Asia. And then it went to Korea. And the old expression, the time to buy is when there's blood in the streets. Sadly, in Korea, there was blood in the streets. People got killed in financial riots in September, October 1997. But here's the point. It entered a quiet period in December, January, February. Things calmed down and everyone said, it's okay. And by the way, long-term capital was fine. At the time, we were like looking into Asia for investment opportunities. But then it came back in April in a small way, because Sandy Weil was selling. He was merging Citi and Travelers. He owns Solomon. And he told the Solomon guys, I don't want any volatility in earnings because I don't want to mess up this deal. So you guys have to reduce your books. But the process of Solomon getting out of swaps, widen the spreads, we're sitting there long term like, hey, spreads are blowing out, buy more. That was the way they thought about things. And then, of course, it came to a head in August. Russia defaulted on their internal debt, their external debt, and devalued the ruble. It was like a trifecta. And then that caused a panic, and then it got worse. And then finally the bailout at the end of September. But my point is that took a year and almost a year and a half. Yeah. And there was a long quiet period in the middle. So just when you see a crisis evolving and then there's a quiet period, don't assume it's over. It just means that things have been patched up, but it's still percolating below the surface. The second one, of course, the 2007, 2008, 2009 global financial crisis. Now, what happened there? Everyone remembers September 15, 2008, midnight on a Sunday, because you can do it electronically, Lehman Brothers files for bankruptcy, okay? That started in the spring of 2007. HSBC reported lower than expected earnings because mortgage losses on subprime mortgages were higher than expected. And that's when Bernanke actually is on the record in the March minutes of the FOMC said, this will blow over. This will be fine.
I remember it vividly.
Yeah. And then it kind of came to a head in August 2007. That's when Jim Cramer and Aaron Burnett on CNBC goes, they know nothing. They know nothing. And Cramer was right. They actually didn't know anything. But the Fed kept the discount rate and they got the Fed funds rate. And then September, you remember all the September 2007, Hank Paulson's Treasury Secretary, he announced the Super Civ, special investment vehicle. that was going to buy all the credit card receivables from all the banks with government money and then put them into a fund and work them out and all this stuff, which never happened, by the way. It was a dumb idea, but it never happened. But then in December 2007 into January 2008, what happened? The sovereign wealth funds bailed out the U.S. banking system. Abu Dhabi, and they were capped at 10%, but Abu Dhabi bought 10% of Citi, Temasek in Singapore bought, I think, 10% of Morgan Stanley, Kuwait Investment Fund. One by one, those sovereign wealth funds bailed out the U.S. banking system. So January, all good. February, it's all good. What happens in March? Bear Stearns blows up because it wasn't all good. That was the point. By the way, if you ever see a CEO saying it's all good, get your money. Get your money.
Exactly.
It's
That's
fine.
it.
Repo's fine. Liquidity's good. We're rolling it over. It's all good. Get your money out then, because it's not that they're lying. It's just that they don't realize how quickly things can change. So then, okay, so March, Bear Stearns blows up. What happens in June? Fannie Mae. What happens in July? Freddie Mac. What happened in August? The Congress passed legislation bailing out Fannie Mae and Freddie Mac. So once again, this is your second quiet period. It's all good. The Congress saved the day. Even though Bear Stearns, Fannie, and Freddie had just blown up, the Congress, in theory, bailed them out. It was all good. And that lasted about a month. And then September, here comes Lehman. So my point is, financial crisis can have one or more quiet periods. In fact, they usually do. Everyone remembers that when the Krakatoa erupted, but they don't know when the shaking began. They forget that these things usually have a year or longer. So if that's the case, and it is the case, I mean, those are just the facts. What should we say about the 2023 banking crisis? Well, we had this again, March 9th, March 10th, March 12th, March 19th, May 1st, this sequence of failures, big ones, including Credit Suisse. From May to August, we're in the quiet phase. Everyone thinks it's all good. But I've calculated these quiet phases. They last about 3 months, maybe 4. So by that calculation, we should be, now that it's September, we should be at the end of the quiet period getting ready for the second eruption of Krakatoa. So let's put a finer point on that. What are the 8 indicators that the banking crisis is not over and is getting ready to blow? And I'll go through this quickly. Downward sloping yield curves. Now, that yield curve is just the x-axis are the maturities, the y-axis is the interest rates. Yield curves are supposed to be upward sloping. The longer the maturity, the more interest you're supposed to get. If I'm lending to you for 1 month, I want a certain rate. If I'm lending to you for 10 years, I want a higher rate because I'm taking more risk, more bad things can happen. Well, the yield curves are actually going down. What does that mean? It means that the big money, the wholesale money, expects a recession, maybe a financial crisis, and they think interest rates are going to drop like a rock. So why would I take less on my 10-year note than on my 1-month Treasury bill? Well, the answer is I think that 4% on the 10-year Treasury note is going to look pretty sweet when rates hit 2%. So that's what the market is betting. Number 2 is kind of the same thing. There's a downward slope in the SOFR futures curve, SOFR system overnight financing rate. Secured overnight financing rate. It's basically what the euro dollar used to be on the CME, but they got the SOFR thing. But they're downward sloping. Now they're the same message. It's a little different contract. These are futures contracts, so you can go out 1 year, 2 years, 3 years. But whereas the Treasury curve is a spot bet on a long-term rate, the SOFR curve is a long-term bet on a spot rate. Now, as you're betting on what you think overnight rates are going to be a year from now. Again, downward sloping, which means the big money says rates are going to be lower. Well, why would they be lower unless you're going to be in a recession? Third one are negative swap spreads. A swap is basically 2 banks or 2 hedge fund and a bank, 2 counterparties basically say, I'll pay you fixed and I'll take floating from you. And, you pay me floating and I'll receive and I'll pay you fixed. So you're basically swapping interest rate. Now, it's the same thing as owning a bond. If I buy a 10-year note in the market, I'm a dealer. How do I finance it? I finance it in the repo market. I finance it in the overnight. So I'm receiving a fixed rate on a 10-year note, and I'm paying an overnight rate in the repo market. Okay, receiving fixed, paying floating. So all a swap does is like, hey, let's do the same thing, but forget the bond. Like, why do we need the bond? Let's just pay fixed and receive floating, or vice versa, and we'll synthesize the the bond holding with one important distinction, which is if I actually own a treasury note and I'm financing it in the overnight market, I'm getting a rate on a government guaranteed security. If I do a swap with you and I'm receiving fixed, you're not government guaranteed. You might be a really good bank, high quality bank. So in theory, I should want a little higher fixed rate from you than I can get from the treasury to compensate me for the credit risk. That's not happening. The fixed leg of the swap, which is bank to bank or bank to hedge fund, that rate is actually lower than the 10-year treasury note. Well,
Right.
why would I take a lower rate from a bank or hedge fund than I can get from the treasury? It's not a credit issue. Nobody thinks that credit is better than the treasury. It's a balance sheet issue. If I do a swap, it's off balance sheet. If I do a treasury, it's on balance sheet. What does that tell you? It tells you the balance sheets are constrained. It tells you the banks are shrinking the balance sheet. It tells you there's a credit contraction. It tells you that there's a shortage of dollars. There's a shortage of collateral. None of these things are good. Um, Treasury bill auction yields are from the Fed are lower than the Fed will give you for a phone call. So the Fed has a reverse repo facility. If you're a dealer, all you have to do is call up and say, I'll give you cash, send me some treasury bills, and pay me interest on the cash. And I'll keep the interest on the treasury bills. And they will for a phone call. Well, but I can also go into the market at auction for the treasury and buy treasury bills at auction. So, but those treasury bill rates at auction are lower than what the Fed will give me for a phone call. So why would I fight competitively to get a rate that's actually lower than what I can get for a phone call? The
Yeah.
answer is the treasury bill you get from the Fed cannot be rehypothecated. I have to hold it on my balance sheet. I can't lend it to somebody else. Whereas if I own a bill outright, I can give it to UBS and they can give it to JP Morgan, they can give it to Deutsche Bank. The rehypothecation is the whole chain of leverage in the entire banking system. This is
Yeah.
behind the curtain of the Eurodollar market. So the point being, if I'm willing to take a lower rate on a bill that I can pledge than I can get for a phone call, it tells you that there's a collateral shortage. It
Right.
tells you that I'm desperate to get my hands on that treasury bill that I can pledge because there's not enough collateral to go around. The strong dollar, everyone's like, the BRICS are taking over, the dollar's falling apart, debt to GDP ratio is 130%. The US is going broke. Forget the dollar. Really? Well, why is the yen crashing? Why is the euro crashing? Why is sterling crashing? Why is the yuan? They're fighting desperately to keep it above 780.
Mhm.
Why is the dollar getting stronger against every major currency in the world if the dollar is the currency of a country that's going bankrupt?
Yeah.
The answer is there's a dollar shortage. Believe it or not, for all the money the Fed printed, the amount of leverage in the system is 100 times that.
Yeah.
So it goes back to collateral shortage, bill shortage, dollar shortage, shrinking balance sheets, liquidity. There's a whole global liquidity financial crisis coming. At the same time, there's this whole recession coming, and we haven't talked about the recession, but those are the rest of my issues. Declining macros and world trade shrinking. That hasn't happened since the Great Depression. Industrial outputs declining, rising inventory to sales ratios. That means the warehouses are full. They can't sell the stuff.
Right.
And then finally, icing on the cake, massively increasing losses in commercial real estate. So these are all hard data points that speak recession and global financial crisis and tell me that this banking crisis is not over. So hopefully that's all helpful, Shamd. I'll toss it back to you.
Jim, that was absolutely brilliant. You think the dollar is actually going to keep going north then?
Yes. Yes.
Yes. Okay, good.
Yeah.
Because I'm with you on that because I live in Europe and I can't understand why anybody would want a euro. So
Yeah.
that's where I'm coming from.
Yeah. The euro's going down, but kind of holding its own. But the currencies that are really crashing fast are sterling, yen, Chinese yuan, some of the emerging market currencies. But then the euro will join them in the end.
Wonderful. Jim, Thank you so much for this. I appreciate it. I know it's Friday and it is aperitivo time. I hope.
So this is a combination of a 21st cryptocurrency system with a 19th century or 5th century BC, if you like, gold system. You're combining the two, the oldest form of money and the newest form of money. Notice what's missing in everything I just described. No dollars. There's no dollar in that system. You know, I say to people, I do a lot of, I've lectured recently at the U.S. Army War College, and I say, you know, why do you send missiles and bombers and you know, various forms of attack and infantry, et cetera, to attack an enemy? Well, they say, well, we want to, you know, degrade their capabilities, destroy their infrastructure, take out their oil pipelines, their ports, et cetera. That's what you do in a war. So what if you could do all that with a flick of a switch? What if you could do it all by hacking into their financial system, shutting down their stock exchange, shutting down their banks, freezing accounts? You would achieve the same thing. You would degrade the financial capability of your opponent, but you wouldn't have to fire a shot. That's the world we live in today. Unfortunately, all of us, me and all of you, can be collateral damage when that starts to get out of control. So we'll talk a little bit about that as well.
What's the new system Jim Rickards talks about? It's a system where countries trade in a new currency and ditch the US dollar. Jim Rickards made this prediction years ago, but it gets more relevant today. With the current war that is going on, I mean wars with S, the risk got bigger as more countries are taking sides against the United States. So what's the big deal about the new system? What will happen when the world stops using the US dollar? Will the US economy collapse? To really understand what's going on, we need to take a deep dive into the financial warfare. Jim Rickards is one of the masters of this new kind of war. At least there are two kinds of war. There's something called kinetic warfare where you send tanks, missiles, and bomber planes to your enemy. But there's also financial warfare where you hack the enemy's digital system, shutting down their banks, stock exchanges, payment systems, etc. Financial warfare is more deadly than kinetic warfare because there's no blood in the streets and people get depressed because they lose their money, all of it if they put all of their eggs in the digital basket. Financial warfare is not a new thing. In fact, it's been happening since the 19th century. Let's hear more from Jim.
Economic warfare, or financial warfare if you want to be more precise, is not completely new. There are a lot of new things about it that I'm going to talk about, but it's actually been a part of warfare as far back as you want to go. And all three of these examples I've given you are financial warfare tactics, economic warfare tactics, in conjunction with kinetic warfare. So Napoleon had to actually invade Russia. He couldn't put on sanctions. And the British actually had to invade, blast their way into Hong Kong. And the Japanese actually had to attack Pearl Harbor. So the economic and what's called the kinetic, just things that shoot and explode, went hand in hand. Today we're in what I call a new age of financial warfare. You can actually have a financial war without any kinetic activity at all. You can bankrupt a country, you can engineer regime change. I've been involved in a few efforts along those lines. So I say my definition: degrade and defeat the capabilities of adversaries by non-kinetic means, not shooting, not invading, not firing missiles, using sanctions, capital markets, banking systems, exchanges, clearinghouses, payments, channels for cash, stocks, bonds, deposits, etc. These are your weapons of war. Of course, they're financial instruments. Of course, they're how we save and invest, but they can also be used to destabilize countries, and they are being used, and we'll point out some examples. Now, I'm not going to go through everything on this list in detail. Each one of these line items I could do a 2-hour lecture on, so we're not going to put anyone through that. But I want to make the point that there is a long list of statutes and regulations that empower the president to engage in financial warfare or to protect the national security of the United States. The first one, it's got a clunky name, International Emergency Economic Powers Act of 1977. Call it AIPA for short. This was enacted during the administration of President Carter. This actually gives the president dictatorial powers when national security is at stake. And that's not an exaggeration. By the way, in the Roman Republic, they had an office called dictator, and he wasn't a bad guy. It was an emergency empowerment of the leader. So normally you had a council or other figures of the Roman Republic, later the Roman Empire, who were elected. It wasn't widespread voter empowerment. It was only an elite that was allowed to vote. But it was a Republican form of government. There were elections, and people got chosen for these offices. But if they were being invaded, if they were at war, if there was an economic crisis. The Senate had the power to appoint a dictator. It was a 2-year term, but you just had extraordinary powers. You could do whatever you wanted. We have the same law today, and this is it, IEPA. When you read the postmortems on the 2008 financial crisis, you'll hear Ben Bernanke and Hank Paulson, who were Secretary of the Treasury, repeat ad nauseum, well, we really wanted to save Lehman Brothers, we didn't want to go bankrupt, but we didn't have the statutory authority to do it. Nonsense. They did. Either their lawyers didn't tell them, or their lawyers are incompetent, which I doubt. I'm sure the lawyers knew all about this. Or they chose not to do it, which is okay, but don't blame it on the law. You have to take responsibility for your decision. But this law would have allowed the United States government to nationalize Lehman Brothers at the time, because the national security was at risk, because the world was in the midst of a major financial collapse. Trading with the Enemy Act of 1917, this is how we got Bayer Aspirin. Bayer AG, the biggest German chemical company, they had a subsidiary in the United States. President Wilson just confiscated it during World War I under the Trading with the Enemy Act. Interesting footnote, in 1933, within weeks of taking office, President Roosevelt issued an executive order confiscating all the gold in the United States, all the privately held gold in the United States. Well, what statutory authority did President Roosevelt use to issue that executive order? You can't just do it for fun. He used the Trading with the Enemy Act of 1917. Now, I don't know who the enemy was. It was probably us, like the American people, but that's what he used. Anyway, there's a long list here. Skipping one, the Committee on Foreign Investment in the United States, CFIUS. I did a lot of work for the intelligence community over many years in CFIUS. When you say CFIUS, people say, does it itch or burn? But it's an acronym for this committee. This is an interagency committee composed of cabinet officers or their deputies that can reject foreign acquisitions of U.S. companies on national security grounds. Now, when I was doing it, mostly during the Obama administration, the government really leaned over backwards to let deals go forward. I mean, I was working with the CIA, and we did the intelligence. We didn't have any decision-making authority. It was our job to point out the threats. Like, the People's Liberation Army controls Huawei, which is the largest Chinese telecommunications company. But we would report on the threats, but it was up to the Secretary of the Treasury, Secretary of Commerce, and a few others as to whether the deals were going to go through. And they would more often than not come back and say, look, can we mitigate this? Can we let the deal go through, but have what they call a mitigation agreement that says the Chinese guy can't be on the board of directors, or he can't, et cetera. And you'd find ways to do that. Anyway, the Patriot Act you're familiar with, SWIFT, Society for Worldwide Interbank Financial Telecommunications. You all know, like, sort of where the brain meets the spinal cord. That's a really sensitive part of the human neurosystem. SWIFT is the brain and the spinal cord of the international financial system. SWIFT is a message traffic provider where all the major transactions between all the major banks in the world are processed. If there's a central nervous system for the global banking system, it's SWIFT. It's based in Belgium, and when Deutsche Bank sends $5 billion to Citibank, or Bank of America sends $10 billion to Banco Santander, it all goes through SWIFT. If you think of it as a choke point, it's the Straits of Hormuz. Half the world's oil goes through the Straits of Hormuz. Far more than half the world's financial transactions go through SWIFT. If you cut off that choke point, you're going to have serious consequences. I'll come back to that because we're using this today. But my point is, when you have a financial crisis or a financial confrontation, or you're in a financial war, the White House does not have to run to Congress and say, please, please give me some powers. The president has these powers. And Trump has shown more willingness to use them than any president, well, probably ever, but some have used it more than others, but Trump's using it extensively. So he has weaponized these financial tools.
Jim Rickards has explained the tools and regulations that can be used in a financial warfare. Back then these tools were used together with kinetic warfare. But today financial warfare can be conducted without firing a single shot, or totally non-kinetic. Since everything is digital today and we have more advanced technology, the financial war got easier and also more deadly. With a bunch of hackers, billions of dollars can be frozen or even stolen by the enemies. And some of these stolen dollars could be your retirement, your money in the stock exchanges, your savings in your bank account, etc. In the next segment, Jim Rickards will explain what's new about financial warfare, including the 5 steps of financial warfare. Without further ado, let's get into it.
A couple points about financial warfare. In the 21st century, just to distinguish it from the 19th century examples I gave, or 20th century examples. And I mentioned this already, financial war can be completely non-kinetic. In other words, you can fight a whole war through the financial system without firing a shot, and it can be just as devastating to the wealth of your adversary. Cyber financial warfare is what the military calls a force multiplier. A force multiplier is you've got a main body, or whatever. It's an infantry division, it's an aircraft carrier task force, or whatever it is. But you bring something else into play that makes it twice as strong or twice as effective. Whether that's an amphibious landing, or you can cut off telecommunications. These things are called force multipliers because they make your force even stronger. Financial warfare can be a force multiplier, or it can be used in conjunction with other events that are going on. So if you're China and you want to launch a financial attack on the United States, are you going to do it on a day when the Dow Jones is up 800 points, or a day when it's down 800 points? Because sometimes it goes down 800 points on its own. Obviously, the Chinese are going to wait for a day when things are bad already on its own and launch the attack then, and there's your force multiplier, because you're piling on an already weak and vulnerable system, and you're destroying confidence. And then the final point I make is that financial warfare can be decisive. It's no longer just an add-on or a collateral feature of a kinetic war. You can actually destabilize countries, achieve regime change, shut down governments you don't like, and again, I'll return to that. So here's something I put together for the Army. I said, man, so I created the spectrum from ultraviolet to infrared. So over on the left side of your screen are what I would call normal commercial activities. So, Alibaba competes against Google, or Ford competes against Volkswagen. It's normal trade, normal commerce, normal innovation. The next one, a little more over in the blue area. Now you get into cheating. So it's still economic competition as opposed to warfare, but you're dumping excess capacity. You're manipulating your currency. You're stealing intellectual property. So you're breaking the rules. It can still be labeled as economic competition, as I say. So then over in the middle, the green, now we're getting a little more aggressive. These are tariffs, trade sanctions, weaponized CFIUS. When the United States tells Huawei, the big Chinese telecommunications company, that they're not allowed to buy Qualcomm, is that trade or is that warfare? Well, you're getting closer to warfare. That's the point. And again, no shots are being fired, but that's more closer to that part of the spectrum. Out in the yellow, I've got de-swifting. De-swifting is one of those words you only hear in Washington. But what it means is I just kicked you out of SWIFT. That's like going into intensive care, finding a patient who needs the oxygen, turning off the oxygen. Not going to last too long. You cut off access to SWIFT, you cannot get hard currency in and out of your banking system. Doesn't matter if it's dollars, euros, yen, Swiss francs, pound sterling. You cannot transfer that money to your banking system because that SWIFT is how you do it. And then out on the right, this is clearly warfare, malicious cyber attacks on critical infrastructure, taking over order entry systems. When I first started doing this about 10 years ago, we warned that the Chinese had so much money, they could actually fund hedge funds around the world and give them each, $1 billion of capital, which is a fairly large hedge fund. China certainly has the money. And they could open up shop in Macau or Cayman Islands or British Virgin Islands, the usual places, and just start trading completely legitimately. They would just buy and sell stocks and buy and sell bonds and look like any other hedge fund. The brokers would take them out to dinner. They would ingratiate themselves into the system. They would be trusted. They would get more capital, more relationships, and then one day, on a signal from Beijing in a coordinated way, they would massively flood the market with sell orders, sell Apple, sell Google, sell Netflix, sell every stock you own, and sink the market. And that was a real threat, and there were steps taken to look out for that. But where we are today, you actually don't need any money, and you don't need a hedge fund. What you do need are really good hackers. And so what you do, you get into the, say, I like Morgan Stanley, so I'll pick on them, the Morgan Stanley order entry system. Actually get into their computers and flood the New York Stock Exchange with the same sell orders I just talked about, Apple, Google, all the big names, sink the market, do the same thing to the bond market, other commodities, etc. But you haven't actually got any money, and you're not actually trading. You've just captured someone else's order entry system who is trusted and big, and you're flooding the market with all these orders. I say things like this, and some people roll their eyes and they're like, "Oh, that would never happen." Actually, Morgan Stanley told me it would never happen, but it has happened. A couple of years ago, there was a company called Night Trading. They had an automated trading system. Something went awry. Was it hacked? Not clear, but something went wrong. And this company started putting in all these sell orders on the New York Stock Exchange, taking the market down. Nobody could find the kill switch. They were running around the company saying, "Oh, turn it off, turn it off." Nobody could find the person who knew how to turn it off. And they lost $450 million in about 3 hours and almost put the firm out of business. So it actually has happened. But whether that could be done in a bigger way, a more malicious way, I'm sure the answer is yes. That's an act of war. We're not, the red zone is, we're not debating it anymore. This is pure financial warfare.
As Jim Rickards explained before, there are at least 5 steps or 5 levels of financial warfare. But the big question is, are we in a financial warfare? Jim Rickards gives 3 examples in the next segment. Starting with the good old Iran and the mighty Russian power, and then to the weirdest country in the world, North Korea. Many of the tools mentioned in the first segment are being used here, including de-swifting and the new tool which is election interference. The world of financial warfare is so complex, filled with innovations and new techniques that get better every day. But one needs to look at the past in order to learn what's wrong and improve it in the future. Jim Rickards will explain the current financial war that is going on and what we can learn from it.
A couple financial wars going on around the world today. Iran, we're actually in the second U.S.-Iranian financial war. The first one ran from 2011 through 2016. Now, in 2011, the United States kicked Iran out of what's called Fedwire. That's the U.S. payment system. So I said SWIFT is the international payment system, but there's something called Fedwire, where all U.S. dollar transactions and purchases and sales of U.S. Treasury securities go. It's run by the Treasury and the Federal Reserve. We kicked Iran out, so no more dollars. So if you're shipping oil and you're getting paid in dollars, those dollars cannot go to an Iranian bank account, and any foreign bank that helps them do that is going to be fined itself. And there were actually hundreds of billions of dollars of fines imposed on HSBC, JP Morgan, UBS, and other major international banks for violating these rules. So they got the message. Well, Iran said, who cares? We'll sell our oil for euros and we'll get the euros through SWIFT. We don't need your dollar payment system. Well, the U.S. prevailed on its allies in SWIFT, including the fact that, at least today, the chairman of SWIFT is a senior officer of JP Morgan, so the U.S. banks have a big role in this, and we got them kicked out of SWIFT. That's called de-swifting. That's serious, because now they can't get any of the hard currencies. They could ship oil to India and get paid rupees in an Indian bank account. You don't need SWIFT for that, but what are you going to do with the rupees? I mean, how much curry do the Iranians need? So this was a real dead end for them, and it forced them to the table. It did what President Obama wanted. It forced the Iranians to come to the table and start negotiating their nuclear development program, which was the whole point of this financial war. Putin, everyone says, well, he's the bad guy because he invaded Crimea, took it over, and interfered in eastern Ukraine, and interfered with the U.S. elections in 2016. All those things are true. Nobody asked why he did it. He did it because in February 2014, CIA and MI6 interfered in the Ukrainian electoral process. He had reached a modus vivendi with a sort of a pro-Putin president of Ukraine. We decided we didn't like that person. We wanted to peel them off, bring them into NATO, stirred up a little street demonstrations. Next thing you know, the president of Ukraine's on his way to Moscow, and we got somebody in that we like better. And then Putin said, well, two can play. So I'm not defending Putin. He's a bad guy. He's a thug and a killer, but he's also almost at the grandmaster level as a chess player. He's a judo expert, and he was a long career with the KGB and lived in Germany. So he knows he's a very sharp, smart player, knows exactly what he's doing. And everything they've done to us is retaliation for what we did to him. And now we're imposing sanctions on Russia. So this is going back and forth, and it's escalating. So we're in another war with Russia, including tariffs, prohibiting major Russian corporations from refinancing their bonds in Europe, and many other things. And again, as I say, it is escalating. And the third one is our friend Kim Jong-un. We'll see where these negotiations go. Obviously, negotiations are better than war, but we are using what we call maximum pressure on North Korea, major economic sanctions. On top of these financial wars, we have trade wars. And they usually go hand in hand. This happened in the 1920s and 1930s. Here's the troika of trade warriors. On your left, Robert Lighthizer. In the middle, Wilbur Ross, Secretary of Commerce. And over on your right, Peter Navarro, who's the president's trade advisor. Of the three, Lighthizer is by far the most important. I'm not saying the other two don't have a voice, of course they do, but Lighthizer is the big brain. Lighthizer's been doing this since the Reagan administration. Ross doesn't have that big a say. Navarro's the guy they put on TV, so when you see something on TV, it's Peter Navarro. But when you're in the Oval Office, it's Lighthizer advising the president. Lighthizer in the Reagan administration, at a time when the Japanese were completely taking over the U.S. auto industry and Detroit was collapsing, basically put quotas on Japanese cars. He put tariffs on Japanese goods as a way to get them to negotiate, and then imposed tariffs on Japanese cars. And the Japanese said, we'll jump the tariff barrier and put our plants in the United States. And Lighthizer and Reagan said, thank you very much. That's what we wanted, because we wanted those jobs. And where are they today? They're in North Carolina, they're in South Carolina, they're in Mississippi, Tennessee. They're all over the United States, creating hundreds of thousands of very good high-paying jobs with benefits. That's what we got by playing tough with the Japanese. Lighthizer is now running the same playbook with China. A good reason to know that he's practically uncompromising. He's not your typical Washington bureaucrat who's going to roll over. Cyber financial warfare, I won't spend a lot of time on that. I'm sure you've heard quite a bit about it. But I've given a few examples already where if you can hack into these systems, you can imitate the banks, imitate the traders, and cause major market disruption. Now, I talked a lot about the U.S. financial weapons. The IEPA gives the president dictatorial powers, freezing the accounts, trading with the Enemy Act, CFIUS, and all the other weapons in our financial warfare arsenal. The other countries in the world are getting a little sick of this. We implement our sanctions through the dollar, through our control of the payment system. The US dollar is over 60% of global reserves. It's over 80% of global payments, and it's almost 100% of the global oil market. So you don't get very far without the dollar, having the dollars, having access to the dollar payment system, etc.
With all of these financial weapons that the United States owns, countries around the world are getting tired of it. So what are they doing? The latest development is that there's a plan for a new currency that is going to replace the US dollar that is proposed by the BRICS country. I think if you're still watching this video, then you already know what BRICS is. But for those who don't know, BRICS is an acronym for the 5 countries that are forming an alliance to do economic cooperation, and these 5 countries are Brazil, Russia, India, China, and South Africa. They plan to create a new currency to replace, or at least to be a rival to the US dollar. So what will happen if this idea comes into reality? Will the world ditch the US dollar and go with the new BRICS currency? But the idea of a BRICS currency is not new. In fact, they've been cooking it for more than a decade. China, Russia, Turkey, and Iran have been planning this by accumulating a massive amount of gold. And Jim Rickards called this alliance the new axis of gold.
They're beginning to take steps to push back. The first one, here I have China, Russia, Iran, and Turkey. They've created what I call the new axis of gold. They're just getting all the gold they can, as fast as they can. Russia has tripled its reserves in the past 10 years. China has more than tripled its reserves in the past 10 years. Iran, we don't know because they're not transparent, but they might have 100 tons of gold, which is quite a bit of gold, and Turkey's doing likewise. I read this morning that Hungary has increased its gold reserves 1,000%. Hungary's in Europe. It's not Asia. It's not usually considered an enemy. Hungary has taken their gold reserves from 30 tons to 300 tons. Poland bought some gold. Poland's a member of the EU. Why are EU members buying gold? Well, obviously they see it as the money of the future. They see it as a hedge against financial catastrophe and inflation. So that's what's going on. So whenever I look at the Russians, they took the reserves from 600 tons to 2,000 tons. By the way, there are only 33,000 tons of official gold in the world. That's it. When I say official gold, this is gold owned by central banks, finance ministries, sovereign wealth funds, not personal gold, but official gold, 33,000 tons. And the Russians now have 2,000 tons. That's a lot. That's all, almost 10% of all the official gold in the world. So, or about 7 or 8%. But my point being, you have to ask yourself, are the Russians stupid, or do they see something coming that most people don't? Well, I've been to Russia, I've been to Moscow, I have Russian friends, I study them closely. They're not stupid. So clearly they're getting out ahead of the curve, and the Chinese are doing likewise. This is just food for thought in terms of where the system is going. Just make the point that the dollar is declining. I said it's 60% of global reserves, which it is, but that's down from 66% just 5 years ago. So down is down. I do think, there's no magic in this, but I do think when you get closer to 50%, that's a critical threshold. That's a point at which all of a sudden the world may wake up and say, hey, dollar is just another currency, along with euros and Swiss francs and gold and the other things we've been mentioning. So dollar is declining as a percentage of total reserves. Gold is going up. I just showed you that in the last chart. So here's a preview of the future. When I say the future, everything on this slide is already in development or working. So this is not science fiction. This is not something for the 22nd century. It's happening now. Basically, China and Russia are building their own cryptocurrency system. Now, when I say cryptocurrency, don't go out and buy Bitcoin. I don't like Bitcoin. I think it's the worst thing you could do. But the world of cryptocurrencies is not limited to Bitcoin. There are actually over 2,000 cryptocurrencies, some of them quite small. But you could go home tonight with the right software, you could invent your own cryptocurrency. But Russia and China are developing their own. What used to be called the blockchain, today people call it the distributed ledger. So this is distributed ledger technology. They're developing their own coin or token. It'll be heavily encrypted, military-grade encryption, with their own pipes, meaning their own kind of private internet. Imagine an economy that looks like the following. So Iran sells oil to China. North Korea sells weapons to Iran. China sells infrastructure to Russia. Russia sells weapons to China. Russians take a vacation in Turkey because it's a pretty country, and so on. So I've just described a whole trading network, and imagine it's all done with this cryptocurrency. So all we do is keep score. And you can keep score with baseball cards, bottle caps. I mean, it doesn't have to be money to keep score. It's just a way of keeping track. Pegged to the SDR, the special drawing right, and we'll talk a little bit more about that. Managed through a cryptocurrency system that's encrypted and secure. And then every now and then, once a month, once a quarter, once a year, we look at the chits and we decide who owes what to whom, and we settle up in gold. And we put the gold on a plane, fly it over to the other guy, and there it is. So this is a combination of a 21st cryptocurrency system with a 19th century or 5th century BC, if you like, gold system. You're combining the two, the oldest form of money and the newest form of money. Notice what's missing in everything I just described. No dollars. There's no dollar in that system. The SDR, the cryptocurrency, gold, the ledger, the trading network, all play a role, but there's no dollar in that system.